Welcome back. You're still watching Smart Money on CNBC-TV18. Today we're talking about the currency and the impact it has on equity markets globally and in India. We have with us Manish Gunwani, Head Equities at Bandhan AMC, to talk about all of that. Manish, we were discussing before the break about the REER. It's a good measure to evaluate currency. But is the REER of any country always stable, or can it change structurally?
So as we discussed, obviously if your terms of trade change, it changes. And in fact, as a stock picker, it's also a useful tool, because typically when it falls a lot, it's generally a good time to buy the stock market.
Okay.
So for example, if you see Japan, it's very interesting that if you go back 10-12 years, it's RER by one agency, because there are different agencies which publish this number, but it was about 140. Today it is 76. So the currency in inflation-adjusted terms is cheaper by almost 50%.
And Japan has just started performing now in the last 2-3 months.
My guess is Mr. Buffett has started loading up partly because of currency, right? He stays in US, right?
Yeah.
He's looking at it in US terms.
Okay.
And it does look like cheap currency, at least from here.
And what about India? Where are we? Have we reached a bottom if you take the REER or the real effective exchange rate?
If you see India's long-term REER chart, there was one big up move because of the commodity price fall in 2014. But I think India, I am quite positive on the currency, not because REER is cheap, that is a traditional bargain hunting kind of view, but I think the dynamics of India in terms of the current account have massively improved over the last couple of years on a structural basis. So one is that you have about 40% of India's import linked to energy, which is oil, coal, etc., which seems to have obviously become a mature industry. There are EV renewables coming in the long term. So you don't really expect oil to be very high from here. The other very surprising trend, in which I think has caught a lot of macro observers by surprise, is that the service exports, which have gone from roughly 80 billion 3-4 years back to about 140 billion, that's a huge jump, right? So $60 billion delta in 3-4 years, and that seems to have good prospects to grow even from here. So you have your biggest export item at a higher level than your biggest import item, and this growing faster. So structurally, the dynamics of India's current account deficit seem to be improving.
Okay, so India's current account deficit seems to be improving. So that's one macro factor that's positive. From an equity market investor point of view, any other big economic trends that are visible because of the currency movements, apart from the current account deficit that you just mentioned?
So the other interesting part about the dynamics of India's current account is, I think you should see it in two parts. There is the south and west part of India, which is very developed. So in fact, that runs roughly, it's difficult to get precise data, but the south and west part, which is 7 states, they actually are surplus current account by 7 to 10% of their GDP. And the rest is deficit. But the rest is deficit because through government spending, there's been a lot of investments in roads, railways that has been happening over the last 8-10 years. So if you, for example, see the central government resources transferred to states, last 10 years, it's gone from roughly 5% GDP to 7.5%. Now you're going to see that plateau off, because you see fiscal deficit coming down that is correlated with this resource transfer. Now when that comes down, you will see that even the rest of India's current account will improve. Apart from this, there is also policy initiatives like PLI, etc., which are helping that. So you will have both the regions improve in terms of current account deficit, which is why I feel that the Indian currency outlook is probably changing structurally. If not zero depreciation, it will be much lower depreciation going forward versus, let's say, US dollar than it was historically of 4%.
Okay, in fact, we have a very helpful chart there. The services exports has gone up quite a bit actually. It was in 2019 it was barely $11 billion and now $36 billion as of 2023. From an equity market standpoint, anything that any sectors, any companies that are big beneficiaries of this boom?
So first of all, this is just a part of service exports. This is the professional and management consultancy, which RBI breaks out as a separate item in service exports. And if you see 36 billion is actually bigger than chemical exports, which is the more visible China plus one story, right? Oh. Now, unfortunately, a lot of this is unlisted companies because these are Fortune 500 companies opening captive centers in India. And it's more than IT because what you're seeing is activities like accounting, legal, auditing, consultancy. They are actually growing faster. So you can hardly play anything directly, to be honest. But I'm sure that the whole currency dynamics over the next few years will have a big impact in terms of what sectors work. Because traditionally we've been used to seeing rupee depreciate 4-5%.
Yes.
Which is why some of the big export sectors' profitability is probably very high.
Like technology.
Yeah. We'll have to see whether that maintains.
Okay, so services exports, as you guys saw, has more than doubled from pre-COVID levels. So we spoke about that and the surge over there. Anything else that catches your eye from a currency standpoint? And I also want to understand that now, now that you're here with us, there is a lot happening in the economy right now. The market is sort of just about at all-time highs, but refusing to get there. There could be a recession as well in the US, by the end of the year. How do you plan your investments at a time like this? I mean, what do you buy? What do you hold? Do you raise cash levels?
So I think, I really think that the big call is currency because one is the Indian currency part. I think what we probably don't, we're not experts in, but clearly there is some de-dollarization happening globally as well, where central banks are selling dollars. So I think a lot of our debate on markets recently has been about the Fed and monetary tightening, etc., right? But I think if the INR-USD pair, you have Indian current account improving structurally, and if at all the de-dollarization happens faster than we expect, you should expect a big emerging market boom because I think the single biggest variable for emerging markets is dollar trajectory, right? So if dollar weakens, so I'm actually thinking on a risk-reward basis, the market looks pretty interesting.
Okay, so when you say
I have a feeling FIIs
when you say interesting, do you mean the second half of the year is going to be really good? Because that's the narrative that I'm getting, at least that's the views that I'm getting, that okay, things are slow now, but in the second half of the year, things are going to pick up quite a bit. Are you a proponent of that?
I'm not timing it. All I'm saying is from a foreign flow perspective, I'm very, very positive.
Okay.
Because I think, because I just think the currency dynamics are probably driving it more than the stock market dynamics.
Okay. Well, just one final question. Everyone, since you spoke about Japan, anyone and everyone is now bullish suddenly on the Japanese market. And an expert earlier was telling us that even China is looking very attractive now because of a valuation game over there. So in the emerging market context, even if money comes back in a big way, not just emerging markets but Asian markets in general, do you think India will be in the pecking order? India will be on the lower?
Yeah, I'm quite convinced. India will definitely, I think, outperform EM because if you see the EM construct, the EM index, you have a very big weight on China, which is 25-28%, somewhere there. And frankly, it's very difficult someone to figure out China, right? Because even after the reopening, the economic momentum has not been great.
Yeah.
Then you have Korea, Taiwan, which are very linked to US economy, and at least from a 6 months to 12 months perspective, I would think it's very difficult to be decisive on Korea and Taiwan because we all know that US is likely to slow down and go into a recession at some point of time. So when you see the big weights in emerging market index, it does look like India will stand out because it has some linkage with US economy, but obviously not as high as Korea and Taiwan. It has a currency which is undergoing a positive transformation in terms of its current account dynamics. So what's not to like?
Okay, what's not to like? On that optimistic note, we're going to end, right? I mean, everyone is looking forward to some sort of, breakout or boom in the second half of the year. Hopefully it comes through. Thanks a lot, Manish, as always, for joining in and speaking to CNBC TV18. Hopefully we'll get to chat a lot more in your new role at Bandhan AMC. But with that, it is a wrap on this special edition of Smart Money. Thanks a lot for watching. Have a great weekend.